American silver investors just watched their portfolios get wiped out in a matter of hours. If you're one of them, you already feel it. If you've been on the sidelines, you're probably asking the same question everyone is asking. Is this finally the moment to buy? But here's what almost nobody is saying out loud. What happened on Friday, January 30th, wasn't the end of the story. It was the opening scene. Silver dropped around 30% in a single day, plunging from $12,164 down into the high sevens and settling near $84. That one-day crash flipped a switch, one that's going to show its full effect when US markets open on Monday morning, February 2nd at 9:30 a.m. Eastern. I've been tearing through the data all weekend. The futures positioning, the CME margin increases, the overseas reaction, the disaster in India, the technical damage, and what I found has massive consequences for every American holding silver right now. Monday's open could turn into a continued bloodbath, or it could be the buying opportunity of the decade. And the difference comes down to forces most investors don't even realize are driving this market. You need to hear this before Wall Street opens. Welcome back to Chile, the channel where we break down the financial moves the mainstream media either ignores or completely misunderstands. If this breakdown helps you handle Monday's chaos, tap the like button. And if you want updates that hit before the headlines catch up, subscribe and turn on notifications. I spent my entire weekend digging into what happened to silver on Friday, January 30th. While most people were enjoying their time off, I was buried in charts, positioning reports, and margin requirement notices. Clear as throat. And what I found is not comforting. The crash wasn't random. The timing wasn't accidental. And what it signals for Monday's US Open is bigger than most people think. The overseas reaction, the disaster in India, the technical damage, and what I found has massive consequences for every American holding silver right now. Monday's open could turn into a continued bloodbath, or it could be the buying opportunity of the decade. And the difference comes down to forces most investors don't even realize are driving this market. You need to hear this before Wall Street opens. Welcome back to Chile, the channel where we break down the financial moves the mainstream media either ignores or completely misunderstands. If this breakdown helps you handle Monday's chaos, tap the like button. And if you want updates that hit before the headlines catch up, subscribe and turn on notifications. I spent my entire weekend digging into what happened to silver on Friday, January 30th. While most people were enjoying their time off, I was buried in charts, positioning reports, and margin requirement notices. Clear as throat. And what I found is not comforting. The crash wasn't random. The timing wasn't accidental. And what it signals for Monday's US Open is bigger than most people think. Whether you hold physical silver, paper ETFs like SLV, mining stocks, or you've been waiting for a chance to buy, these next 48 hours matter more than you realize. I'm going to break down exactly what caused the crash, what the CME did with margin requirements, what happened overseas while America slept, including India's catastrophic sell-off, and what you must watch when the opening bell rings on Wall Street Monday morning, the January 30th crash. Let me walk you through exactly what happened on Friday, January 30th, 2026, because the details matter. Thursday, January 29th, was the top. Silver printed an all-time record high at $12,164 per ounce. The metal had been running on an unreal 9-month winning streak. American investors had watched silver climb more than 170% from the priority and silver miners. It felt unstoppable. Then Friday hit. The selling started before most American traders even finished their morning coffee. It wasn't slow. It wasn't controlled. It was a waterfall. Huge sell orders slammed the comics. Price ripped down through support after support. Stops started firing across thousands of accounts. Margin calls hit electronically. Forced liquidation poured gasoline on the fall. By the time the dust settled, silver had dumped over 30% in a single day. Some intraday prints showed it as low as $78. By the close, silver hovered around $84. That's the worst single-day collapse since March 1980. More than 45 years ago, billions in value vanished. American retirement accounts holding metals took damage. Miners inside the S&P and Russell got hit even harder than silver itself. Some down 40% to 50% in one session. As of Sunday, February 1st, silver is trading around $85 to $86 in overnight action. Still massively higher than $32 a year ago, but catastrophically lower than Thursday's $12,164 peak. And the media gave you the same surface-level excuses they always do. Profit-taking, dollar strength, technical selling, generic filler. That is not the real story. The real story is positioning, leverage, margin hikes, and a market that was set up perfectly for this kind of move. The real cause, mainstream American financial media, doesn't understand silver. They cover it like it's a normal stock. Supply and demand, sentiment, analyst notes, upgrades, downgrades. But silver doesn't trade like that. Silver is dominated by derivatives, futures, and options on the COMEX in New York. Paper claims that massively outweigh the available physical supply. Here's what actually triggered Friday's crash. Catalyst number 1, the Kevin Warsh Fed chair nomination. Friday morning, before the market opened, President Trump nominated Kevin Warsh as the next Federal Reserve chairman. The market read that as reducing the risk of extreme dollar weakness and calming fears around Fed independence. The dollar jumped. Gold got hit about 9%. Silver, being the more volatile metal, got hit even harder. That was the spark, but the explosive material was already stacked up and ready. Catalyst number 2, the CME margin hikes. This is the part the mainstream barely mentioned, and it's the most important piece of the entire story. The CME Group, which runs the COMEX, where US silver futures trade, raised margin requirements twice in the week leading into the crash. On Tuesday, January 28th, the first hike pushed silver margins from 9% to 11% of notional value for non-heightened risk profiles. Heightened risk profiles rose from 9.9% to 12.1%. This was announced while silver was ripping to record highs. Then on Friday, January 31st, the second hike raised gold margins to 8% from 6%, and silver margins were raised again to ensure adequate collateral coverage. What that means in real dollars is everything. Each COMEX silver futures contract represents 5,000 ounces. At $120 per ounce, that's $600,000 of notional exposure. Before the hikes, a trader needed roughly $54,000 in margin per contract. After the hikes, that jumps to roughly $66,000 to $72,000 per contract. When margin requirements rise by $12,000 to $18,000 per contract, leverage long traders suddenly need fresh cash immediately. If they don't have it, they only have two options: deposit more money or get liquidated. Most people don't have spare cash sitting around, so the broker sells their position automatically. No debate, no choice. Force liquidation. Thousands of American traders got margin called on Friday. They were forced to sell into the crash at the worst possible moment. Their selling triggered more selling that created more margin calls. The chain reaction fed on itself. This is the same playbook. 1980, silver collapses, margins crush the rally. 2011, silver falls from 49 to 82s. Margin hikes annihilate leveraged longs. December 2025, silver approaches $90. Margins spark a sharp correction, clears throat, raise margins, trigger liquidation, smash price. It works every time. And they just did it again. Catalyst number 3, extreme positioning. Before the crash, the commitment of traders' positioning showed speculative longs at extreme levels. Too many retail traders on one side, everyone bullish, everyone leveraged. When everyone is already in, there's nobody left to buy. So, the only direction left is down. Large commercial players, banks, and institutions knew this. They saw margin hikes coming. They positioned for it. Catalyst number 4, the technical failure. Silver tagged 12,164s, an area traders had been eyeing for years. When silver couldn't break above and hold, technical traders started selling. Combine that with margin hikes and the worst headline, and you get algo selling that accelerates the collapse. This move wasn't random, it was designed. And once you understand that, you understand why Monday matters, what happened overseas. Now, let's talk about what happened in Asia and Europe over the weekend while American investors were asleep, because this sets the tone for Monday. India's catastrophic collapse on Sunday, February 1st. India's silver market got crushed. MCX silver February 2026. Futures plunged as low as 2,91,922 rupees per kilogram, roughly a 97 per ounce equivalent. That's a drop of about 45,000 rupees per kilogram. In one session, around an 11% to 15% decline, depending on the region. In Chennai, prices reportedly fell as much as 85,000 rupees per kilogram. Mumbai, Delhi, Kolkata panic selling across major hubs. Why did India crash so hard? 3 reasons. 1. Massive profit taking after silver surged to around 4.1 lakh rupees per kilogram just 3 days earlier. 2. Hawkish global cues tied to the worst nomination. 3. Extreme caution ahead of India's Union Budget 2026. Why this matters for America on Monday is huge. India is one of the world's largest physical silver markets. Historically, Indian buying has cushioned Western sell-offs. But when Indian buyers are panic selling instead of buying dips, that signals stress in global physical demand. That selling pressure going into Monday creates a negative mood before New York even opens. If the India weakness spills into Shanghai and Hong Kong overnight, the US market could gap down hard at the open. Shanghai and Hong Kong reaction. This is still developing. Asian markets that trade Sunday night into Monday morning, US time, will set the tone. Early futures action suggests volatility, but direction isn't locked yet. Physical premiums in China are sending mixed signals. Some reports say Chinese buyers are stepping in on weakness. Other reports suggest selling pressure is still present. That divergence, paper crashing while physical holds up, matters. It hints that real metal demand may stay strong even as paper markets unravel. London adds another layer. European institutions are split. Some see the drop as a gift. Others see it as the start of something worse. LBMA inventories will be watched closely. If silver is leaving London vaults even after prices fell, that's a bullish sign of real demand. Overnight futures action Sunday into Monday has been choppy between 82s and 80s. Rallies get sold, dips get bought. It's a two-guff war, and what happens overnight is going to tell American traders what kind of Monday they're walking into. If Asia stabilizes silver above 85, Monday could rebound. If Asia pushes it below $82, Monday could turn ugly fast. The technical damage Friday's crash blew through multiple major support zones. 110, 100, 95, 90 gone. $85 is barely hanging on. These were levels where buyers previously defended aggressively. Breaking them all in one day suggests those buyers either got overwhelmed or they quit. Monday's key question: can silver reclaim any of those levels? If it does, Friday could end up being a shakeout. If it doesn't, those old supports become resistance, and the path lower stays open. Silver also cut down through its 20-day, 50-day, 100-day, and 200-day moving averages. All major moving averages are now above price. Classic bearish structure. Friday's volume was massive, the highest in years. High-volume down days often mean conviction selling, but capitulation bottoms also happen on high volume when the last sellers finally puke and strong hands step in. Monday will tell us which this was. The weekly candle is one of the nastiest in silver history. Snorts. A massive red weekly close near the lows that often leads to follow-through selling. But extreme weekly candles can also mark turning points like 1987 or the 2020 COVID crash. Monday will either confirm bearish follow-through or start to undo the damage. The COMEX delivery situation. Here's what mainstream media isn't telling you, and American silver investors need to understand it right now. COMEX inventories are near crisis levels. As of late January 2026, total COMEX silver inventory is roughly 440 million ounces, but registered inventory, metal available for delivery, is only about 124 million ounces, around 28% of the total. Recent withdrawals show roughly 33.45 million ounces removed in just 7 days in early January. That means about 26% of deliverable silver vanished from COMEX in a single week. Now look at March 2026. The March contract open interest represents over 500 million ounces. Registered inventory is only 124 million. That's roughly a 4.1 paper-to-physical imbalance just for March. This system only works if most traders cash settle or roll forward. If they demand delivery, the math breaks instantly. First notice day is February 27th. On February 27th, traders holding March contracts can begin standing for delivery. That's when we find out if COMEX can actually meet delivery demand. If demands exceed supply, we could see force majeure declarations, cash settlements instead of metal, a breakdown of paper pricing credibility, or explosive upside in physical silver. That's why Monday matters. This crash may have created a rush of physical demand as people try to grab real metal at lower paper prices. If physical delivery spikes while registered inventory stays tight, the squeeze risk rises. China's export controls another key factor heading into Monday. China controls an estimated 60% to 70% of global refined silver supply. China officially classified silver as strategic and implemented export controls starting January 1st, 2026. That restricts overseas sales to state-certified producers. The global silver market starts to fracture into regional islands. Asia dominated by China's licensing North America, centered on COMEX and tight inventories. Europe centered on LBMA, stuck between both. Before controls, silver flowed to wherever price was highest. Now flow is restricted. American industrial users, solar, EVs, electronics, can't easily access Chinese supply. They have to bid through COMEX or alternative sources. That creates structural support for American silver prices. Even if paper crashes, industrial buyers still need metal. They don't care that silver fell from $121 to $84. They care about securing supply. Monday's wildcard, China. If China tightens export restrictions again, or if reports hit that American industrial buyers are scrambling to secure metal at these discount paper prices, Monday could reverse hard. Watch China-related headlines Sunday night into Monday morning. It can completely reshape the open. Monday scenarios. Here are the 4 realistic paths for Monday, February 2nd, 2026. Scenario 1, continuation crash, 20% probability, silver gaps down to $780 or lower. Asia and India selling continues. The 9:30 open brings another wave of liquidation, another 5%, 10% drop, more margin calls. By end of day, silver tests 7075. Miners fall another 20%, 30%. This happens if Asia dumps hard. CME threatens more margin increases. Physical premiums collapse and buyers stay away. Hold physical. Consider slow accumulation only at truly extreme lows. Scenario 2, dead cat bounce, then failure, 30% probability. Silver opens slightly higher, 8790. Bargain hunters push it up and everyone breathes. Then the rally dies. Sellers fade the bounce. Broken $95 now acts as resistance. By close, silver drifts back to 82.84. This happens if Asia sends mixed signals and traders hesitate ahead of the jobs report. Reduce overexposure. Don't chase. Wait for clarity. Scenario 3, V-shaped recovery, 35% probability. Silver opens $88.92 and climbs all day, closing back above $95.100. Buyers attack the dip, shorts cover, silver reclaims broken levels. The story flips from crash to forced margin liquidation and opportunity. This happens if Asia shows strong buying, especially China. Physical premiums stay firm and institutions deploy cash. If you're waiting to buy, you'll need to act, but stay disciplined. Scenario 4, gap down, then violent reversal, 15% probability. Silver gaps down to 70 under $80. Panic returns, headlines scream, weak hands capitulate. Then a switch flips. Mid-morning, a whale buyer steps in. Deliveries spike or China news drops. Price rips higher. Shorts get trapped. Buy close, silver finishes 88.95, far above the open. This happens if big players run stops to accumulate and physical tightness becomes undeniable. What American investors should do. Now, let's get specific based on what you actually hold. If you own physical silver, coins, bars, rounds, you're in the safest position. Your metal can't be marginal called. A broker can't liquidate it. Comics games can't auto-sell it. My suggestion, don't make emotional decisions based only on Monday's tape. Physical silver is long-term strategic insurance. Friday was brutal on paper, but you're still massively up versus a year ago. That said, Monday could offer rare adding opportunities. If we get scenario 1 or 4 gaps into $75, $80, those might be you'll never see this again prices. Stay calm, stay deliberate. If you bought silver as protection against monetary system risk, that thesis didn't vanish in one red candle. Hold. If you own SLV or other silver ETFs, you already got gapped down Friday, and Monday can gap you again. You cannot react to overnight moves, so decide now, before Asia opens Sunday night, what you will do in each scenario. If SLV gaps down 10% at the open, are you selling, holding, or adding? If SLV gaps up 5%, are you selling into strength, holding, or adding? Make that decision now while you're rational. Write it down if you need to. Then execute Monday, regardless of emotion. If your overweight ETFs in Friday made you feel physically sick, consider trimming into any strength. This volatility isn't for everyone. If you own US silver miners, First Majestic, Heckler, Pan American Silver, miners got annihilated Friday. Many dropped 40%, 50% in one day. They can swing even harder than silver itself on Monday. Review your sizing immediately. Can you handle a 30%, 40% move either direction in a single session? If not, you're overexposed. Also, review quality. Strong balance sheets, low debt, profitable operations. Those can survive and recover. High debt, weak operations, poor management. Those can go to zero if silver stays depressed. If you're holding low-quality names, Monday could be your last clean exit before bankruptcy risk becomes real. If you own quality names and you truly believe in silver long-term, Friday may have created historic opportunities. If you're thinking about buying the dip, Friday might look like the opportunity of a lifetime, and it might be, but buying a falling knife can destroy you. My suggestion, don't rush at the Monday open. Let the first 30-60 minutes show you the market's intent. If we're in scenario 3, you can still buy later and catch most of the move. If we're in scenario 1, you'll be glad you waited. Scale in. Don't go all in. Buy 25% of your intended position Monday. If it drops, buy another 25%. Average in. Don't try to nail the exact bottom. And if you're buying, strongly consider physical over ETFs or miners. If comics delivery issues widen the paper physical gap, the real metal can behave very differently from the paper price. If you're leveraged or trading on margin, this part is for people trading comics futures or margin accounts. My critical suggestion, close or drastically reduce leveraged exposure before Asia opens Sunday evening if you haven't already. Friday proved that 30% moves in one day are real. CME proved they will raise margins at the worst possible time. You can be right long-term and still get wiped out short-term. If you can't close before Asia opens, at least pre-plan. What's your pain threshold? At what price do you exit voluntarily to avoid forced liquidation? Do you have cash ready for margin calls? Do not make these decisions in real time Monday morning. Fast markets punish hesitation. Program your exit levels in advance. If you're in cash on the sidelines, you're in the best position. You have optionality. You're not bleeding every hour silver moves. Be patient. You do not have to act Monday. If Friday was capitulation and we get scenario 3, silver can recover with or without you. You can still participate. If Friday was just the first leg down and we get scenario 1, you'll likely see better prices later this week. Let Monday's price action and volume give you information, then make decisions Tuesday or Wednesday with more clarity. The bigger picture, let's zoom out. Many Americans bought silver to protect against inflation and dollar debasement. With inflation elevated, national debt above $36 trillion, and the Fed boxed in, that thesis made sense. Friday's crash doesn't erase the fundamentals. Massive deficits, ongoing money printing, real inflation, eroding purchasing power, fragile monetary plumbing. But Friday does raise a real question. If silver can fall 30% in a day, is it safe? Silver has never been stable. It's volatile, always has been. 1980, 2011, and 2026 prove it. Silver isn't a short-term safe haven. It's a long-term strategic asset, and volatility is the cost of admission. Also, industrial demand is structural. Solar, EVs, AI data centers, 5G, defense electronics all require silver. That demand doesn't vanish because a chart crashed. It actually makes silver cheaper for industrial users. Their buying should support price somewhere where 85-75 Monday gives clues. If comics can't deliver metal when it's demanded, the implications are severe. Best case, paper price disconnects and physical becomes worth more. Worst case, COMEX credibility collapses and pricing breaks. Most likely, forced cash settlements, premium spikes, reduced trust, but the machine keeps running. From Monday through February 27th and into March, we'll see which path plays out. Psychological preparation. Now, let's talk about the part that breaks most people. Psychology. If you held through Friday, you're rattled. Watching 30% vanish in hours is trauma. You might feel fear, regret, doubt, paralysis. If you sold Friday, you may feel relief, regret, or fear that Monday rebounds without you. If you've been waiting to buy, you might feel greedy, vindicated, or terrified of catching a falling knife. Whatever you feel Monday morning is probably pushing you toward the wrong move. Fear makes people sell bottoms. Greed makes people buy tops. Hope makes people hold losers too long. Regret makes people chase. The market transfers wealth from emotional investors to disciplined ones. So, the solution is simple. Hard, but simple. Make your decisions before Monday's open. Decide now at what price you'll buy more, at what price you'll reduce, at what price you'll do nothing. Write it down. Then on Monday, execute the plan, not your emotions. Final thoughts. Friday, January 30th, 2026, will go down as one of the most violent days in silver history. A 30% crash off all-time highs, billions erased, thousands of American investors wrecked. But context matters. In March 1980, silver fell from $50 to $10 over time and took decades to recover. In 2011, silver fell from $49 or $82 and didn't sustainably clear $25 until 2020. In March 2020, silver fell hard during COVID and then doubled within months. Which path are we on now? Monday won't answer that completely, but it gives the first major clue. Even after Friday, the facts remain. Industrial demand is strong and growing. COMEX registered inventory is tight. China export controls fragment supply deficits persist. Mine supply can't ramp quickly. The paper price crashed. The physical shortage didn't magically disappear. So, this could be a historic opportunity or a brutal value trap. One question decides your Monday. Are you a trader or an investor? Traders care about Monday's gap and short-term survival. Investors care about 2027 to 2035 and use crashes to accumulate. Both are valid, but you must know which one you are because the right Monday action is completely different. Survivors will be the ones who manage risk, have a plan, understand their time frame, and control emotions. The ones who get wiped out will be over-leveraged, reactive, and decision-making and panic. The weekend is almost over. Monday is coming. Make your choices while you still have time. If this helped you prepare for Monday, February the 2nd, tap like right now. One click helps other silver holders find this before the bell. Share this video with anyone you know who owns silver, because they need to see this before 9:30 a.m. Eastern. Subscribe and turn on all notifications. Monday could get wild, and I may drop real-time updates during the session. And comment your plan for Monday. Are you buying the dip, selling the rip, holding tight, or reducing exposure? I read every comment, and I want to see how other silver holders are handling this. The crash already happened. Now we deal with what comes next. See you on the other side. Stay sharp, stay disciplined,